All right, welcome to the Explainer. Today we're taking a walk down Wall Street, but maybe not the one you're used to seeing on TV. This is a random walk, and it's based on Burton Malkiel's absolute classic of a book. The big question we're tackling is there really a secret to getting rich in the market, or are we all just taking a guess?
So it really boils down to this one simple question, right? Is investing a game of skill, kind of like chess, where the smartest person with the best strategy wins? Or is it more like a casino, where in the long run, the house always has the edge, and any big win is really just a lucky roll of the dice? Put simply, can you, can I, can anyone really outsmart the market?
Okay, to get to the bottom of that, you got to understand there are basically two big schools of thought on what even gives a stock its price. On one hand, you've got the firm foundation theory. These folks believe every stock has a real, solid, intrinsic value, based on its assets, its earnings, the hard numbers. The game here is to figure out that value and then buy the stock when it's selling for less. But then on the other hand, you have the castle in the air theory. This theory says forget intrinsic value. A stock is worth whatever the next guy is willing to pay you for it, period. Here, the goal isn't financial analysis. It's about guessing what the crowd is going to do next. The famous economist John Maynard Keynes had this brilliant analogy for this whole castle in the air idea. He compared it to a newspaper beauty contest from his day. To win, you didn't pick the face you personally thought was the prettiest. No, you had to pick the face that you thought most other people would choose. And the really smart players? They take it one step further, trying to guess what the average person thinks the average person will pick. So you see, it's not about crunching numbers. It's about playing a game of mass psychology. So this whole castle in the air thing, this focus on what everyone else is thinking, well, that can lead to some really, really dangerous territory. When an entire market starts trying to guess what everyone else will do, you get what we call a speculative bubble. And as history shows us, time and time again, these bubbles have a nasty habit of popping. And look, this is nothing new. This pattern is as old as markets themselves. You had tulip mania back in the 1600s in Holland, where people were trading their houses for a single flower bulb. I mean, can you imagine? Then in the 1700s, it was the South Sea bubble in England. Fast forward to the Wall Street crash of '29, and then in our own lifetimes, the dot-com bust in 2000. The details change, right? The technology, the asset, but the human behavior, it's the exact same story. People building bigger and bigger castles in the air, totally convinced that this time it's different. And if you want to see just how nuts things can get, just look at this number. That is the one-day stock price gain for a company called theglobe.com back in 1998. This company had basically no revenue, no real business plan, but its stock shot up almost 1,000% on its first day of trading. The logic? There was no logic. It was pure speculation. Everyone just betting that some other sucker would pay an even crazier price for it tomorrow. Now, you might be thinking, okay, that's just foolish people getting carried away. But listen to this. The person who said this was Sir Isaac Newton. One of the most brilliant scientific minds in all of human history. And he lost his shirt, an absolute fortune, in the South Sea bubble. I mean, that's a seriously humbling thought, isn't it? You can be smart enough to figure out gravity and the laws of motion, but that doesn't mean you can predict the madness of a crowd. All right, so we get it. Regular folks can get swept up in the emotion of it all. But what about the professionals? The people with the fancy degrees, the Wall Street jobs, the expensive suits. Surely they can beat the market, can't they? So let me ask you straight up. Do you believe the pros, the so-called smart money, have what it takes to consistently come out on top? Do you really think these experts have some secret sauce that lets them see the patterns the rest of us just miss? Well, when Burton Malkiel actually dug into the data, the answer he found was a big fat no. The technicians, the people who stare at charts all day looking for wiggles and trends, turns out they couldn't consistently predict anything once you factor in their costs. And what about the fundamental analysts, the number crunchers? Their forecasts were often no better than just assuming next year would be like this year. And worse, their recommendations were often biased. The takeaway is pretty stunning. When you look at the people actively managing money for a living, most of them, the vast majority in fact, fail to do better than the overall market. The pros? They aren't outsmarting the market either. Okay, so if the crowd is just guessing and even the so-called experts can't consistently beat them, what is going on here? Why is it so hard? Well, the answer lies in the book's big central idea, the random walk theory.
And the idea is actually incredibly simple. It says that in the short term, where a stock's price is going to go next is completely unpredictable. It follows a random walk. That means its next move is no more predictable than the outcome of a coin flip. What happened yesterday or last week or last year gives you basically zero clue about what's going to happen tomorrow.
The thing is, our brains are hardwired to find patterns in everything. I mean, look at this chart right here. It looks like a normal stock chart, doesn't it? You can spot the trends, right? You see the clear upswing, it hits a peak, there's a decline, then it starts to recover. It feels like it has a story. You feel like you've got a handle on it, right? You probably have a gut feeling about where it's going next.
Okay, you ready for the big reveal? That chart has absolutely nothing to do with any stock. We literally created it by flipping a coin. Heads it goes up, tails it goes down. That's it. The pattern you saw, the story you told yourself, was just your brain doing what it does best. And that just perfectly shows the whole random walk idea. Our brains will invent a story, a pattern, even when there's nothing there but pure random chance.
So if trying to outsmart the market is basically a fool's errand, what are you supposed to do? Just give up? No. Malkiel says there's a much simpler and way more effective path forward. It's not about some get-rich-quick scheme. It's about getting rich slowly, but surely. And look, if you need one chart to burn this into your brain, this is it. Imagine you put 10 grand into the market back in 1969. If you just put it in a simple, boring S&P 500 index fund, one that just buys and holds the biggest 500 stocks, by 2014, you'd have over $736,000. But if you gave that same 10 grand to the average professional money manager to actively trade for you, you'd have ended up with just over 500,000. Think about that. That's the difference. Just by doing nothing, by being boring, you would have been richer by almost $250,000. Wow.
So what does that mean for you? Well, the strategy becomes just beautifully simple. Step 1, stop trying to find the needle in the haystack. Just buy the whole haystack. Get a broad, diversified index fund. Step 2, just hold on for the long haul. Let your dividends reinvest and work their compounding magic. Step 3, keep your costs as low as you possibly can. Every dollar you pay in fees is a dollar that isn't working for you. And step 4, probably the hardest one, do as little as possible. Basically, tune out all the noise and just let it grow.
And all this brings us back to one final huge question. I mean, the evidence is pretty overwhelming and the strategy is about as simple as it gets. So why is it so incredibly hard for so many people to just do it? Why do we keep getting tempted to build those castles in the air, to chase the hot stock tip, to believe that we're the one who can outsmart everyone? It really seems like the hardest part of investing isn't about the stock market at all. It's about mastering our own minds,